We've had kind of two semi-disappointing cycles. So the one cycle only got to 69K, and then this one only got to 126K so far. Go back actually to diversification. It's unfashionable when Bitcoin is soaring. Diversification looks really stupid. When Bitcoin does have one of those 10x moves, it's like, wait, you own stocks and gold, like too? But then when you have a flattish period, especially, in a portfolio that rebalances and stuff, you kind of lean into those weaker moments. And then naturally, you're not putting as much capital in when it's in its kind of peak phases. Kind of my approach and kind of what I've generally recommended is that, you can own your favorite asset, but that there are other assets worth owning too.
Bitcoin has experienced two underwhelming cycles in recent years. The first topped out around $69,000 before cascading into a brutal reset, shaking out late buyers who believed six figures were inevitable. The latest rally stretched further, peaking near $126,000, yet still fell short of the euphoric parabolic blow-off many had penciled in. Now Bitcoin sits around $67,450, down 0.5% on the day, digesting $360 million in spot ETF outflows last week. Futures open interest has cooled, leverage has thinned, and the casino noise has faded. Meanwhile, whales continue accumulating near the $65,000 support zone, even at a short-term loss, hinting that patient capital may be quietly absorbing exhausted sellers as a base slowly forms. This is the part of the cycle that tests conviction, not the violent crashes, not the vertical rallies, the boredom, the chop, the creeping doubt. Macro analyst Lyn Alden often stresses diversification during these sideways stretches. It sounds unnecessary when Bitcoin is ripping 10 times, and everyone mocks your slow stock or gold allocations. But in stagnant phases, diversification becomes a psychological stabilizer. Rebalancing forces discipline, selling strength, buying weakness, without emotion. It keeps you from overcommitting at euphoric highs and gives you dry powder when sentiment turns sour. Owning your highest conviction asset alongside other durable ones doesn't dilute belief. It strengthens it. You're no longer dependent on perfect timing. You're building resilience instead of chasing adrenaline. Watch clips from the interview for further insights into Lyn Alden's conversation. Please like this video, subscribe to the channel, and turn on post notifications for more content. Thanks for tuning in. Enjoy the rest of the video.
I heard you say on an interview that we really didn't see retail adoption in this last cycle. Why is that? I've totally noticed it myself because content's obviously impacted by that, but where's retail? Why are they not buying in?
Well, I think one, because there's been the bull market was fairly weak. I think what attracts retail a lot of times is when you have an asset that's outperforming every other asset in the world. And people say, well, I have to learn more about that, what's going on there. But when you have RAM stocks soaring and GPU stocks soaring and other kind of AI related things soaring, when Bitcoin is like doing okay, when it was, going over 100K, it was a fine market, but it wasn't like a unique thing, at least in terms of price action. So I think that was kind of, that was probably a downward force on getting retail in this time. I try to avoid price predictions, but I was on record saying anything under 150K would be pretty disappointing. Yeah. We only got to 126. It's hard to say exactly what I think one is that what I mentioned about the AI drawing a lot of attention. And I'm not the first person to point that out. I think it's competing for attention with assets that are performing as well or better than it over the past few years. I think the precious metals bull run also kind of drew some attention. And like I said, the lack of any sort of broad crypto thing, like often as noisy as that is, it kind of gets a lot of people's attention. It's just basically, other than meme coins and some kind of financial nihilism going on, there wasn't really anything happening there. And I think a lot of people have kind of heard about Bitcoin at this point. So I just think there wasn't, it's almost like there's a barbell. So, and the two sides didn't show up. So sovereigns didn't really show up. Mm-hmm. People were talking about the strategic Bitcoin reserve a lot last year. I was on record saying I'm not going to, expect that really. Mm-hmm. And then the other side is retail didn't really show up. And instead, the only real players this time were kind of in the middle, the corporate institutional side, kind of higher net worth retail that have a brokerage account, and the ETFs opened up to them, made it easier. But not really like a deluge of people buying Bitcoin, taking self-custody of it, learning about it, doing the whole podcast circuit. Mm-hmm. That was kind of absent this time. Well, we'll see how low we get. But I think, the larger the asset gets, the more liquid it is. It's harder for any one entity to really move the price around. Like not like one failed exchange. There's still some really big kind of groups out there that own a lot. But for the most part, the bigger it gets, the less that's able to happen. I think the derivatives part is like inevitable, meaning that once an asset's this big, there's no world we have a multi-trillion-dollar asset that is kind of magically only owned by retail. Institutions are going to get in if it's successful, and that's something it has to go through. I think that unlike gold, where the paper games can go for literally years or decades because taking custody of it is so challenging and costly, those paper games go a long time till they break. And in Bitcoin, because it can be tested so quickly, whenever there's kind of a whiff of insolvency, it's pretty easy to test. So I think those kind of derivatives and stuff, while they can kind of inflate quote unquote supply and IOUs for a period of time, I don't think that's the chief reason. I think mainly just the top line demand was kind of mediocre or this cycle. And I think that played the biggest role in not having the explosive upside. I do think it's healthy not to have those kind of, say, a 20x run and then a 90% crash. I mean, that's inherently part of a smaller asset that generally behaves like that. I mean, right now, oil's still very cheap despite all of this, which is actually pretty interesting. I mean, that helps keep inflation down. Obviously, inflation shows up wherever there's bottlenecks, and power is not very fungible. Kind of like how natural gas can have really big dislocations where, one continent can have a natural gas price that's multiple times higher than natural gas on another continent because it's way harder to arbitrage that than it is with oil, just because the transportation costs are so high. And power is a similar way, which is, you can't just magically teleport spare power to where there's a need for power. And so, power is in demand. And to some extent, I mean, people were always worried about Bitcoin mining driving up less electricity costs. This actually kind of does it because unlike Bitcoin mining, AI data centers, one, they want to have high uptime. They can pay quite a bit for power, whereas Bitcoin miners have to find the absolute lowest cost electricity, which means basically stranded either in space or time. And Bitcoin miners didn't really care about like being near population centers, give them Starlink and they're happy to mine in Antarctica for all they care. Whereas data centers for AI, all else being equal, they prefer being closer because it reduces their latency. So we actually do see an issue where they do compete with, industrial and residential prices in many cases. I think whenever you have a rapid change, there's dislocations. I think eventually the market figures it out. Eventually we probably have oversupply of all the things we're short on now: GPUs, RAM, power, data centers. We'll have a period of probably getting overbuilt, and then we'll contract, and I think we'll go farther from there. Just like how farmers got tractors and that made them way more productive. I think basically workers around the world are going to get AI agents and I think everyone's going to get way more productive, even though it's obviously a very disruptive time as that comes online.
You said that a big print would have to be $2+ trillion or more of expanding the balance sheet. So why gradual for you?
Mainly because the conditions are not such that they would need a big print in the near future. I mean, unless something unexpected happens, like I mentioned in that piece, if a worse type of war breaks out, or if there's more kind of financial war going on, there are scenarios that can absolutely result in a big print or a nuclear print. But when the really big numbers happen, like the QE1 happened at a time where banks were extremely levered. They had very little cash relative to either their total assets or relative to their deposit base. That was kind of peak long-term debt cycle in the private sector. And so you start from a tiny base and you go up to pretty big, high cash ratios. Now, I mean, bank cash ratios are still pretty high. And as long as you don't have something like COVID scale disruption to the economy, which, can always happen, but it's not my base case, then I wouldn't really see printing of that magnitude happening. Now you look out far enough, anything can happen, but when you have like say a 1 to 2 year starting point for analysis and say, well, what's going to happen in that time frame? They've kind of hit the rough floor for how much cash they can take out of the system. There are some levers they can pull if, like, for example, the new chairman does try to get the balance sheet down, unlike Jerome Powell. But I think they'll be limited in that. And just right now, when you kind of run the numbers of how much debt is coming out, how much money supply is growing, how levered or unlevered banks are, they just don't really need a lot of printing. A little printing gets them a long way. The Fed can buy a little bit of the bonds, and then also as that expands the size of the banking system, they can also buy bonds on fractional reserve. So I think that the system is going to go on for quite a while in a state that doesn't need massive printing.
In the recent cycle, retail investors stayed away from Bitcoin because the bull market felt weak compared to other assets. Stocks like RAM and GPU companies tied to AI surged dramatically, pulling attention and capital elsewhere, while Bitcoin's climb past $100,000 was solid, but not outstanding. Precious metals also drew interest, and without broad crypto hype beyond meme coins, everyday buyers didn't rush in. Many have heard of Bitcoin by now, so it lacks novelty. Sovereign adoption like strategic reserves didn't materialize either, leaving corporate institutions, high net worth individuals via brokerages, and ETFs as the main players, not the self-custody crowd hitting podcasts. As Bitcoin grows more liquid, single entities struggle to sway prices much. Derivatives are inevitable for a multi-trillion-dollar asset. But unlike gold's drawn-out paper games, Bitcoin's easy testability limits prolonged supply inflation. Top-line demand stayed mediocre, curbing explosive gains. AI data centers compete for power unlike flexible Bitcoin mining, causing short-term dislocations in energy markets, though productivity gains from AI agents will eventually balance things out. Gradual Fed balance sheet growth makes sense now, as banks hold ample cash ratios without crisis-level leverage or shocks like COVID. Small prints suffice via bond buys and fractional reserves. Let's go back to the interview and watch more clips to gain insights from Lyn Alden.
Where do you think capital is going to come from in order to maybe push Bitcoin to the upside? And what markers are you looking for maybe a Bitcoin bottom to be in?
I think initially, kind of like the diamond hands put the floor in, which is to say that the fast money gets out, the coins rotate from fast money hands to strongly held hands that are really not going to want to part with it unless it goes up like 5x or more, basically that kind of buyer. And then eventually it tightens supply. And then it only takes a marginal amount of new demand to come in. It could be, for example, that the AI stocks eventually just peak. They get so silly big that they can't really get realistically much higher. And then Bitcoin's cheap for a while and it's in strongly held hands. And people start to notice that, hey, it's going up again and it's under-owned and no one's talking about it. And then, of course, bull markets kind of feed the narrative after that point, kind of like we saw in precious metals, where once it starts running, then people hop on. I don't think we've seen the end fully of the treasury company buying spree, which is to say that, obviously, I think some of the MNAVs we're not going to see at the level that we saw in 2025. But I think some of them will be still buying in the years ahead, like Strategy and others. And then when you do have that rising environment, people look around and say, well, how can I lever that? In the least risky way, and they might look at some of the treasury companies and bid those up, and if they get a positive MNAV, they can buy. So I think that's kind of part of the bull markets going forward.
But you do think that there's more downside risk that we haven't put in a bottom necessarily?
I mean, I started back in December and January. I was working with the assumption that November bottom, might be the bottom. That was kind of my base case, but we invalidated that case. Historically, Bitcoin rarely makes V-shaped bottoms outside of, say, like COVID stimulus type of events. Normally, it hits like a low level and then goes sideways for quite a while. I think we're in more of a grind, but a grind could literally be 10K lower or it could be 20K higher, and it's still in that grinding part. So I don't really have kind of foresight on exactly where it's going to bottom. I think it'll be a process that takes time.
You did a report with Sam Callahan about how it's normally correlated to M2 and liquidity, but I feel like liquidity and M2 have been at record highs and we saw a divergence. Can you talk a little bit about that and how often we might see those divergences and why?
Yeah, in that report, I mean, at the top of my head, I think it was 83% of the time it goes in the direction of liquidity, and the other 17% it doesn't. The most common reason it doesn't is because of valuation. So when you have a very high, let's say, market cap compared to like average cost basis, so you have a very big disconnect, you're more likely to get a divergence where liquidity and money supply are still going fine and Bitcoin's selling off just because a bubble can't necessarily, a local bubble can't be maintained just because liquidity is still decent. This has been one of the 17% of the time where it's kind of gone in different directions. I think in large part it's because of that shadow of AI, that there are other things for that liquidity to want to go into. And then there are other proprietary measures of liquidity, like cross-border capital, for example. They've got their own more proprietary data. For our article, we wanted basically publicly available data, which comes with limitations. Whereas if you have a proprietary indicator, it's hard for other people to go check it, but it can potentially yield more accurate results. And for example, he's been arguing that liquidity is not going up right now, that it's actually more strained than it looks. And that's certainly possible. There are still a number of central banks that are reducing their balance sheets. The kind of the tightening of the Japanese bond market is a downward force because they're a major creditor nation. So we're not really in like an explosively positive liquidity environment. There's some debate about how good or bad it is, but it's not amazing. And like, some of the more risk-on things you see, like when PMIs, like purchasing managers indices, are going up and the economy's kind of raging, we don't really see any of that in this period of time either. So a lot of assets that are outside of like the AI sphere are kind of grinding, and you get random winners and random losers, like Latin American banks somehow doing amazing, AI stocks obviously doing amazing. And other things not. And then lately, Bitcoin's been correlated to software stocks to an unusual degree.
And those have been selling off. Yeah,
they've been selling off. I think, somewhat rationally, but I think eventually they'll get oversold and they'll be buying opportunities. And then it's possible that the algos just jump on. The trading algorithms say, well, Bitcoin's software, right? And then they kind of trade in sympathy with each other. I would say there's two parts of the thesis. One is that a decentralized ledger is valuable. And that it's more valuable than, say, its current 0.2% of global assets. People can debate what that number is. Bull would say whatever number it is higher than 0.2%. It could be a 2% is a 10x. 20% gets you to 100x. So it's like, okay, well, if you're higher than 0.2% on the kind of the total addressable market, then there's a bull case, at least over many years, not any given 6-month or 12-month period. The second part is basically arguing which one then. Bear might say, well, they'll fracture and there'll be 10 different popular ones and none of them will get big. Someone who focuses on network effects, however, will generally argue that, basically that one is going to win, basically Bitcoin. And that part of the thesis has been strong lately. I mean, we had basically no alt season outside of little pockets. The second biggest cryptocurrency has not made a new high in Bitcoin terms since like 2017. It's only 20% the size of Bitcoin. So I think Bitcoin 17 years in is firmly kind of winning that network effect and security argument. And the part that just still remains challenged is that top line demand. What is the level of demand for a decentralized ledger? I would argue that it should be higher than it is now, but obviously the market has disagreed. There just has not been a lot of buying pressure. And I think, people used to like to point out how often it took the internet to catch on and then Bitcoin catching on quicker. Well, that narrative's damaged because AI just came and people could see right away how this could potentially help them. And a lot of people, because Bitcoin's kind of use cases are often not needed immediately. Right. Obviously, some countries are needed immediately, or if someone gets debanked, they're needed immediately. But for a lot of people, it's more like insurance, where they don't really necessarily even know they need it. And I think that kind of slows down its adoption. So I think the thesis is still sound that a decentralized ledger is attractive and probably worth more than 0.2% of global assets. And certainly that second part is stronger than ever. That kind of the fact that Bitcoin is kind of unique in this regard compared to the long tail of other cryptos. But that top line demand has just not been here this cycle.
Lyn Alden explains that Bitcoin's bottom likely forms first through diamond hands. Fast money sells off, rotating coins to strong holders unwilling to part unless prices surge 5 times or more. Supply then tightens, needing just marginal new demand to push upside, perhaps as AI stocks peak after getting unrealistically huge. Bitcoin could look cheap in firm hands, drawing notice when it starts rising quietly, much like precious metals narratives ignite once momentum builds. She notes treasury companies like Strategy may keep buying, though not at 2025's M&A frenzy. In a rising market, investors seek low-risk leverage via these firms, bidding up positive NAV plays. Alden sees more downside risk, having assumed a November bottom that got invalidated. Bitcoin rarely V-reverses without stimulus, often grinding sideways, potentially $10,000 lower or $20,000 higher. On liquidity, her report with Sam Callahan showed 83% correlation to M2 historically. Divergences hitting 17% mainly from overvaluation. High market cap versus cost basis lets bubbles deflate despite decent liquidity. AI siphons funds. Proprietary measures like cross-border capital suggest strain amid central bank tightening. Bitcoin's thesis rests on decentralized ledgers deserving over 2% of global assets, bolstered by network effects trouncing alts, the second largest coin stuck at 20% Bitcoin size since 2017. Yet top-line demand lags, slowed by Bitcoin's insurance-like appeal versus AI's instant utility. As we conclude, what are your thoughts on this interview? How are you handling Bitcoin's flat cycles in your own portfolio, all in on Bitcoin, or spreading risk with diversification like Lyn Alden suggests? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.